depreciation is great, but when you go to sell, there's something called depreciation recapture you have to be aware of. Hi, my name is Matt Coach. I created this YouTube channel to share the tips, tricks, and mistakes on my way to building an 8-figure real estate portfolio. And one of the many big pluses of real estate is that you get a write-off called depreciation on your taxes that can help offset any gains you're getting, say, from rent inside the house. So a lot of people utilize this depreciation write-off to essentially pay no money on the rental income that they are acquiring from their property, and it's over like a 27.5-year time frame. It can be quicker than that, but for the sake of this video and what I'm trying to talk about, I'm actually referring to, well, you get that write-off, right? What happens when you go and sell the property? So if you have a house that you got for $200,000 and you've depreciated $100,000 of that property, right? Your basis for the property is now $100,000. So that difference, that $100,000 you write off, you actually have to pay ordinary income tax on when you go to sell the property. So that's not capital gains tax you're paying, it's ordinary income. For real estate, they cap it at 25%. At least last time I checked, it was capped at 25%. So you would pay on that sale $25,000 in taxes. Plus, if you sold it for $300,000, right, you would pay 15% capital gains or 20% capital gains, whatever your capital gains tax bracket is, on that $100,000 of gain you had from the property, right? So you buy it for $200,000, you've written off $100,000, right, and you sell it for $300,000, right? So this $100,000, $200,000 that you have of write-offs, you're paying 25% on, and this $200,000 to $300,000, you're paying capital gains tax on. So this is something to be aware of when you hear about, how to not pay taxes inside of things. It's like, well, you do pay taxes on the sale. That's where they get you. Even if you 1031 exchange your property, which is where when you sell a house, you buy another house very quickly right after and you pay no capital gains tax, or that depreciation recapture, they'll take that depreciation out of your cost basis of the property, or your depreciable cost basis of the property. So they're still going to recapture that over the 27.5 years you have of that new house. So this is something to be aware of, that if you ever wonder why rich people do not sell a lot of their stuff, it's because that depreciation hit is very big on taxes. And I don't know about other assets that are capped, but for the most part, depreciation is taxed at your ordinary income tax bracket. So you could be looking to pay 30-40% of that back to the IRS upon sale. It's capped for real estate at 25%, but still, it's something to be aware of for all you guys. And if you've ever had that question, why don't they just sell everything that they have? That's why, because then they pay taxes afterwards on all of it when they sell it. So hopefully that is something that helps you guys out, or something to bring up to an accountant or whatever if you're thinking about selling some of your assets. See ya.